China's property spiral. Can Beijing stop the slide? China's economy is facing a critical turning point, a dangerous spiral that could reshape its future forever. From soaring real estate to manufacturing giants fighting to stay afloat, a relentless cycle of overcapacity and price wars is threatening to push the nation into uncharted territory. The question is, can Beijing step in, or is this the beginning of a long, painful slide that could ripple through the global economy? Stay tuned as we dive deep into China's property crisis, the forces driving this dangerous cycle, and what it means for all of us. This is China's property spiral, and the stakes have never been higher. The involution phenomenon. At the heart of China's current economic woes lies a phenomenon known locally as involution. Originally a term used in anthropology, involution describes a situation where relentless effort and competition produce diminishing returns. In China's economy, it manifests as fierce price wars, oversupply, and shrinking profit margins across multiple sectors. A recent study by Natixis, analyzing 2,500 listed Chinese companies, underscores this troubling trend. The data reveals that while corporate volumes, sales, production, or capacity are growing, the actual value generated is declining. Alicia Garcia Herrero, Natixis' chief economist for Asia Pacific, pointed out that, on the surface, companies seem to be dominating their markets, but deep inside, they're paying a high price to do so. Many firms are resorting to discounts and price cuts to stay afloat, but these strategies only deepen the cycle of deflation and low profitability. Official data paints an even starker picture. Consumer prices fell by 0.1% in the first half of this year, and factory gate prices, the prices at which manufacturers sell to wholesalers, plunged by 2.8%. Only a handful of subcategories of producer prices showed gains, highlighting the widespread nature of deflationary pressures. This environment discourages investment, stifles innovation, and leads to layoffs, further fueling economic slowdown. Deepening economic challenges, the consequences of involution extend beyond corporate balance sheets. The broader economy feels much colder than the headline GDP figures suggest. Larry Hu, chief China economist at Macquarie, noted that mainland Chinese companies listed on the A-share market expanded their workforces by just 1% in 2024, the slowest pace on record. While official growth figures for the second quarter are projected at around 5.2%, slightly below the first quarter's 5.4%, many analysts warn that the real challenges lie ahead. Overcapacity, a long-standing issue. China has grappled with overcapacity before. About a decade ago, excessive capacity plagued state-dominated sectors like commodities and steel. However, today's challenge is different. The rise of private companies in overcapacity-prone industries complicates government efforts to coordinate mergers and reduce excess supply. Policy responses and strategic shifts. Despite the difficulties, China's top leadership remains committed to stabilizing the economy. A high-level Politburo meeting scheduled later this month is expected to reaffirm an emphasis on demand-side stimulus, measures aimed at boosting consumer spending and investment. In March, Beijing increased the fiscal deficit to 4% of GDP, signaling a readiness to deploy more fiscal resources. The external threats, trade war and global spillovers. Adding to China's internal difficulties are external pressures. The ongoing trade war with the US and the European Union has intensified scrutiny on Chinese industries, especially those with excess capacity. Both trade partners have imposed tariffs, particularly targeting China's electric vehicle and solar panel sectors. Goldman Sachs analysts warn that these trade tensions are prompting Chinese manufacturers to accelerate efforts to build factories overseas. This push for overseas capacity risks creating redundant supply chains globally. Goldman estimates that, by 2028, capacity in sectors like electric vehicles, solar modules, and steel could be significantly oversupplied, many well above actual global demand. 7 key sectors: air conditioners, lithium batteries, EVs, semiconductors, steel, solar modules, and construction machinery are already operating with more capacity than global markets can absorb. Only a few, like air conditioners and EVs, have some room to grow, but even these are barely keeping pace with demand. China's property and manufacturing sectors are caught in a challenging cycle of overcapacity, deflation, and intense competition. While policymakers are aware of the risks and are taking steps to address them, the road ahead remains fraught with uncertainty. Whether Beijing can halt the slide and how long it will take is a question that will determine not just China's future, but the stability of the global economy as well.